All right, I want to continue our discussion on inflation from a couple of videos ago. And I want to get across a very important principle that investors really should be thinking about inflation as broadly as possible and not just think about it in the way that we're told to think about it by the media or by our government. And obviously the sort of the most basic way to think about inflation is CPI inflation, the consumer price index, right? Well, what's the CPI? It is a basket of goods chosen by a government agency, essentially, and adjusted. The data in that basket is sort of tortured to take into account different quality adjustments or hedonic adjustments, and most likely that number is understating actual inflation. I mean, there's a whole meta debate about that, of course, but then of course, that's how inflation is defined kind of in the simplest sense, right? But then there's your personal experience with inflation. And what you're concerned about with your economic road is the things that you want to buy in the future. What are the prices of those things going to be when it comes time for you to buy them? So, the problem facing someone with a teenage daughter who's about to go to university in the next, say, 4 to 5 years, the inflation in the tuition of a brand name university is a very salient part of your personal basket of inflation items. Well, Harvard's tuition or Brown's tuition or whatever, that is not in the CPI, right? And then this takes us to kind of another major genre of inflation that's just not measured really in inflation statistics, and that's asset inflation. And to think about that, so let's think about a scenario where you want to purchase some quantity of risk-free investment income. Maybe you want to invest in CDs or government bonds. And, if the 10-year bond is, say, at 4%, 10-year treasury, it's at 4%, $1 million of money invested in 10-year treasuries will produce $40,000 a year in income, risk-free. Likewise, if CD rates are at 4%, the same thing, $1 million in a 4% CD produces $40,000 a year in income. Well, so what happens when the 10-year bond goes from 4% to 1.5%? All of a sudden, that $1 million in assets produces only $15,000 in risk-free income. Likewise, the same would be true for CD yields if they went from 4 to 1.5%. So what's happened? Well, the amount of capital that is required to produce $40,000 worth of income has significantly increased because of this reduction in interest rates. And so this is another type of inflation where in order to produce, say, a relatively low-risk annuity of cash flow, you need significantly more capital to do so. That's a type of inflation. Likewise, you can make the same argument about stock prices in one way. So, for example, if the S&P 500 goes from 2,000 to 3,000, the index level, one way to think about that is that's 50% inflation. Now, of course, it depends where you're standing on your economic road, whether this is good or bad, right? If you're already long assets, if you're already, you've already made most of your investments over the course of your life. Let's say you're 60 and you're basically done working and this is your pool of assets. Well, you're happy, right? You had 50% appreciation in your portfolio. But this is a terrible disaster if you're someone who's beginning your road road to retirement. You're now buying into a basket of assets that is more highly valued than it was before. And so this is a problem for you. And so you may need to cast your net more widely to try to find solutions to your specific problem you're trying to solve. So this is the whole idea of thinking about inflation very broadly. We're given numbers, right? But those may not be the numbers that you're specifically facing. And you want to think about what are the challenges you're going to face and how can you possibly solve them. And then I'll leave this video with a resource. One of the things that got me actually thinking about this was when Michael Saylor did his early tour of podcasts late last year. He did a really good podcast with Preston Pysh, and I'll link to it in the comments or in the description below this video, where he talked about sort of a more expansive, more broad way of thinking about inflation. It got me to think about it too, and hopefully this will help you think about it as well. All right, thanks for watching.